Our next guest, highlighting some of his top picks in the beaten-up real estate sector, the REITs. BMO analyst John Kim joins us now. John, we were just wondering, coming off a conversation on commercial real estate and some of the pain in office, would you go into one of these office REITs like an SL Green or Boston Properties right now? Would you buy it?
The issue is you're going to stick your neck out to an office right now, but if you're a value investor and you're looking over the next 3 to 5 years, there's a lot of value in office. There was a report that came out of JLL yesterday. The bottom 30% of office assets accounts for 90% of the vacancy in the market. So the trick is to be in the top 70% of the market. Companies like BXP and SL Green have a lot of assets in that top 70%, if not better.
So you like them? They're among your top picks.
Yeah, I mean,
and dividends are high yields.
BXP's dividend yield is 7.5%. SL Green is over 10% right now. There's a risk that SL Green cuts it at some point. It's not going to happen until the end of the year, but BXP at 7.5% is very solid.
It's going to take a while, though, isn't it? For sort of the confidence would seem to be regained, even if the assets, as you say, are much stronger than maybe perceived.
I mean, office has cyclical and secular headwinds. You can make the case that the secular part is starting to turn a little bit. When you're looking at Citigroup and Google saying that part of your performance reviews will be your in-office attendance.
Office, right?
They're not out of the woods yet. And on a cyclical basis, companies are still downsizing. They're still taking less space. So there's still a lot of headway to go for the next couple of years. But that secular part, I think, is really interesting to watch over the near term.
And how much does it matter by municipality, right, or downtown area?
Yeah. I mean, look at New York. New York is back. And if you walk around Midtown, not today, Fridays no one's working, but Midtown is back. Things are busy. I think that, the Castle data is saying that 60% occupancy on the busiest days. I think that's a little bit understated, but it's certainly back, and it's better than most other markets.
That's it. You don't have a lot of job growth, though. I mean, you've got large technology companies cutting back, even the Alphabets of the world that have taken so much space here in New York, or Meta. Is that a concern?
It is a concern. I mean, they've taken a lot of space. They have layoffs. But when you look at what happened in Austin, Amazon took more space in Austin because they're bringing back people. They don't have enough space for all the office workers. So that's not every market. That's not every company. But it's an interesting tidbit and see if that's a trend.
What about industrial REITs? Is that a safer spot with also high yield? Industrial
is safe. The yields are not as high. We like Stag because the yield is a little bit higher at 4.2%. But the mark-to-market on these portfolios are very strong. For Stag, it's 25 to 30%. For a company like Prologis, it's in the mid-60% range. So market rents don't have to move, and you'll still get a lot of embedded growth that will be realized.
Why is industrial so much stronger in a time where we are seeing a downturn in many parts of the economy?
There was just a lot of supply chain issues that need to be reconfigured, so that created a lot of demand. And vacancy rates right now in industrial are 2 to 3%.
Now, REITs move with rates, too, though. I mean, that's always a risk for you, isn't it, if
Absolutely.
rates keep moving higher?
Yeah. So overall, we are cautious on REITs because higher interest rates, slowing economy is not great for the sector. There is a lot of value in the sector. There are certainly some names that are trading at very discounted prices right now. And if you look over the next 3 to 5 years, supply is really going to come down a lot because of higher construction costs, higher interest rates. So once the economy comes back, the fundamentals are going to be so positive for REITs.